Well, good morning. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. We're going to start our second quarter 2024 market update and outlook in just a moment. We're allowing others to join. Again, if you have the opportunity to join us today, wonderful. If you can't stay for the entire broadcast, then we'll send you a link and you can watch at your leisure and whenever it's convenient for you. And you can also share with friends and family or even colleagues and anybody that you think may benefit from this. But we're happy to do this as we have clients all over the United States and some even around the world as they travel. And so they always want to stay connected. That's why we provide this opportunity with Blanke Schein Wealth Management to go through markets, insights, and observations. So let's get an update right now. I think we can start getting the green light. So thank you for joining us. Today, we're going to discuss basically the frequently asked questions and what to watch. Obviously, we're going to discuss markets, earnings, the Fed, inflation, and the state of the U.S. consumer. Number two, we're talking about geopolitical events and the historical market outlooks. Number three, what sectors might be most attractive moving forward? Number four, will the U.S. economy enter recession? If not now, when? And what should investors be watching for in the next 6 months? Let's get right into it. Again, we ask you to like and subscribe. We have a YouTube channel. We have over, right now it's 90,000 views, total watched hours, 3,000 watched hours, and about 1,700 subscribers. And every Tuesday and Thursday, I try to give a video update to our market insights and observations. So please stay tuned to our YouTube channel, follow along. As an example, we're all around the, we're constantly being featured in Fox and a contributor to CNBC, Bloomberg, so on and so forth. Tonight, I will be on CNBC Street Signs at 7 p.m. Pacific Standard Time, so check us out at that moment in time. But here's a cool photo. We got a client of ours that was traveling the world. Again, it was 2 o'clock in the morning for us. I was in our Palm Desert studio, basically for a 5 a.m. Eastern hit, but our client was on a cruise in Portugal. So on the other side, half side around the world, and they had the opportunity to check in. He sent a photo of this and says, "Hey, we know this guy, Forbes." The HighTower story, most of you know it. If not, bottom line is we're a growing firm, and we have a national presence with boutique feel. At the other side of the coin, what makes us different is our fiduciary standard versus the suitability standard. The fiduciary standard, we are accredited investment fiduciaries. Both Rick and I are, and that's basically, that means that we're legally obligated to what's our client's best interest on par with a CPA or an estate planning or even an attorney. That's the oath that we take versus the rest of the world is basically in the, hey, listen, if the product fits, then it's okay. We take it to a higher level. So that's very important. Blanke Schein Wealth Management takes a long-term approach with everything we do, and we don't get distracted by the headlines. And that process and discipline keeps us dispassionate about the markets, but patient and able to take advantage of the opportunities. This is for our CP or our attorneys, our disclosure. Now let's get right to it. And also, what makes HighTower a little bit different in the sense that we have access to anything that Wall Street has to provide, access to research. More importantly, third-party research. So it's not just one solution, one size fits all. It's more of a custom boutique access to whatever Wall Street has. In the morning, both Rick and I get substantial, all these investment resources and all this research plus more. What we like most are the independents. We're going to show you a lot of the research that we've dug up for sort of the compilation of today, and we'll see how powerful that actually is. Another differentiator about Blanke Schein Wealth Management is this right here. What's important is most clients, if not most new relationships, view us as, okay, well, let's look at the investments, right? Oh, the retirement account, the 401k, the stocks, the bonds, your personal finance column. So the one in the middle here is the 5 comprehensive steps to the wealth management experience. And oftentimes our industry only focuses on this. Oftentimes the consumer only talks to the advisor about the investments. What we've learned in our 40 plus years of experience with Rick Sr. and our 40 plus years built for the future is the fact that most investments are here for 2 things. One, to derive income from those investments, and also to provide that lifestyle, that worry-free retirement. And what really could derail this on a bigger scale is if you don't plan for the healthcare, right? And you have all the healthcare components that are looked after, advanced medical directive, medical power of attorney, and so on and so forth, or even long-term care and how you're going to pay for it. That could put a big wrench in the whole investments if you're not planning for it appropriately, as well as estate planning. We encourage everyone every 3 years, unless the tax law changes and the state law changes, which it could in the next 18 months or so, visit with your estate planning attorney and have all your documents, all your estate, look after and make sure it's up to date to the current law of the day. Laws will change, so you have to have it reviewed. But if you don't have your legacy locked down and your healthcare locked down, then the investments could be really thrown for a loop. So we encourage that. And the process that we take advantage of for every single one of our clients is we start with a customized financial plan. We have a 3-document solution, your past, present, and your future. And if you haven't had your financial plan updated, please, we encourage you to reach out, because life is always, it's not static, it's dynamic. There's always money in motion. There's always financial decisions. Our job is to use this dashboard of approach to make certain that we're on the same page, financially speaking. Did we hear you? And more importantly, we can model solutions. Hey, listen, we want to go a trip around the world. We want to pay for some college, or we want to buy a second home, or how do we finance this home to buy that home in a market that's hyper competitive? We can model this for you. Therefore, we always say you measure twice and cut once to ensure that you have confidence and clarity about your finances moving forward. So again, every one of our clients has one of the financial plans in place. We always update them, and they're living, breathing documents. As your life changes, so can this plan. We can model that before you do anything moving forward. Again, we're financial planning driven. We love providing the education, much like in today's programming, or even on a one-on-one basis. Know why you own, what you own, and what it's supposed to do for you is very important. The guidance is all of years experience, and our investment process really speaks to itself because it's married to the investment plan that is custom to you. So the investments and the investment solution is custom to you. And the service, we couldn't do anything what we do without, we have Sherry and Leslie and Valentina, and every one of us here to help. Madison and Rick and myself as a team, we have a total team approach to make certain that you feel, if we're doing our job properly, you feel like you're our only client. All right, today's discussion, we're going to talk about basically a prospective historical market look on volatility and returns. Number 2, inflation and restrictive policy, the Fed's last mile. And don't forget the ECB that plays a component into that: energy, elections, and earnings outlook, and AI. So let's go to it. What do we do right now? It's a crazy time in the world. I've used this slide, and I haven't changed this slide for the last 3 market updates. Quite honestly, it's timeless, if you will. We're always going to have geopolitical events. There's always the fight between the bull and the bear. The presidential election is now sort of in the middle of everything right now. Congress is agreeing to disagree on multiple levels. We don't have to spend any time on that because it's just a fact. Jerome Powell is at the center because of monetary policy being restrictive or accommodative. Inflation, we're seeing inflation hit, as well as the home market. Everyone's waiting for, in the first 6 months of 2024, to buy a home for anticipation of interest rates coming down. Well, there's signs that there was a most recent article that showed that when interest rates drop, if they drop, when they drop, home prices could see another 20% reacceleration to the upside. So it's very concerning, especially for those homeowners that have been holding out. That could be a major issue. And there's a lot of reasons why that points to that's not far off as to what could actually happen. And the question is, okay, well, what about a recession ahead? So let's talk about all this. Perspective, historical markets, volatility, and returns. Well, we always like to go back to this because this is a slide that goes back to basically 1970. We can take this back 100 years of the S&P 500 index, but this is just showing all the different, ultimately, things to worry about, crisis and events. Obviously, the most recent events of Iran and Israel over the weekend add another sort of mix into the calculus as to something we have to worry about as we're going through this. But this chart shows the growth of $10,000 based upon the S&P 500 over the last several decades. We basically look at listen, the markets always historically climb a wall of worry. They climb it in the major crises when events develop. It's always important to have fresh perspective and a long-term approach. But every one of these little indications are something to worry about. Again, clients hire us to worry and take advantage of situations. When markets pull back, it's not always a bad thing. It's okay to have markets take a breather, because long-term markets, again, climb a wall of worry. In this case, under this sort of scenario, you got a 10.83% annualized rate of return for the S&P 500, which is pretty amazing. Another historical look at basically the bears versus the bull markets. And this is going back to 1942. This chart shows the daily performance of the S&P throughout the bull and bear markets since 1942. We believe looking at historical markets and expansions and recessions help gain fresh perspectives and the benefits of investing for long term. So ultimately, what you're looking at, those big blue mountains are the bull markets, and those periods on average last about 4.2 years on average, with a cumulative return of about 147% over those periods of time. Okay, some are longer, some are shorter, some are more cumulative total return, some are less cumulative total return. But if you average those out over 1942, that's what you're looking at: just under 4.5 years, and about just under 150% return, which isn't bad. Conversely, when there's bear markets, those last just under 12 months, so 11 months on average, with a maximum drawdown of down 31% on average. Not maximum, it's an average drawdown, 31.7%. Ultimately, what that means is, yes, markets do pull back. In any given year, there's a pullback of 5 to 10% on average. And then there's the bear markets, which is a technical definition of a bear market, is when the market actually hits down 20% in that calendar year. So you can see historically, as we look through that, and the gray bands here are what you're going to see as it relates to the recessions. Recessions hit and markets basically anticipate that. But there are those years where they're the go-go years as they result. And this is a feast or famine chart. We like to take a look at sort of, again, the S&P average. This is on this chart, goes back to 1926. And the average of the S&P, as we said, is around the 10% annualized. But did you know that there are only 6 years when the S&P 500 actually landed within that average of 10%, plus or minus, out of all of those calendar years, or 97 years in total in the sample set? So when we say the average of 10% for the market, historically speaking, close to the last 100 years, that's only happened 6 times. Well, then, Rob, what else happens? Well, if you look to the right of the slide, the calendar year performance ends from 12% to 20%, sort of a total return year. You've got a whole bunch of them here. And then more than 20% is ultimately what you're seeing here. And that's the one that takes the cake. So that pulls the average up. Now, what scares us all is what you see is the far left, worse than 20%. You have 1, 2, 3, 4, 5, 6, 2008, 2002, 1974, 37, 31, and 30. So post in the wake of the Great Depression, you got 3 years out of those 6 years that are ending the year of down 20%. It happens, but historically, you got to put it into perspective and understand sort of, you even have the 70s in there, 1974 down 26.5% for the S&P. And then the next, just to the right of it, it was down 14.7% in 1973, the year before. So 2 years in the 70s were not so good for markets. And historically, this is a great graph to sort of put life into perspective. Again, this is another way of volatility, as we've seen. So to start the second quarter this year, the first quarter S&P is up 10%, great start, less volatility. Now we're seeing 11 out of maybe 10 out of 11 trading days to start the second quarter, heightened volatilities to be expected. What this shows ultimately is you can't always time the market, okay? It's also important to know that as markets go down, these drawdowns in every calendar year are normal. And this is how those particular years ended up. So there are years where the market was down in 2009, in 2009, it was down 28%, but it ended up 23% higher, okay? 16% down, ended the year up 13%. There are some years where it was down 19%, and then it ended flat. So there is volatility in the market, and we know the averages are down there. I'm not going to spend too much on this, but let's say when we do hit recession, there are recessionary drawdowns as these orange bars are showing. And this is recounting all of the recessions, historically speaking, dated back to 1953, 54. But the 1 year, 3 year, and the 5 years, you look at that rebound. So obviously we'd love to time it, get out before the recession, and then jump back on. But even if you ride it out, you actually have an average of, again, the 10% on the S&P if you have longer term perspective. Here's one that we have from First Trust, and the US stock market returns during major wars. Now, there are several wars happening in today, a lot of geopolitical turmoil. We don't know if it's going to escalate. We don't know where it's going to go from here. But even at that, there are wars. So going back to World War II, Korean War, Vietnam War, the Gulf War, Iraq War, and then the far right shows, listen, the market returns from 1926 to February of 2024, the annualized return of markets, if we look at all of those averages, again, it's 10% by the market, as measured by the S&P, going through all of those different wars. Some wars are in terms of that period of time, the market did better, believe it or not, but they're all positive, believe it or not. And the volatility is 17%. So what you're going to get is more volatility, which is to be expected that we're seeing, but longer term perspective over that period of time, wars don't mean negative for the US economy, or at least for the historical market returns. Now, what's the number one concern for the Federal Reserve? What's the number one concern? I've used this slide now 3 times, and I haven't changed a thing, and it's simply because it's playing out. If you watched any of my media, sort of year end, even year to date per media hits, if you will, we have been, Blanke Schein Wealth Management's been on the camp of higher for longer, meaning the Federal Reserve is going to have to keep interest rates higher for longer, simply because there are green shoots in the economy. Again, the job market's still strong. We're seeing a lot of turning for the positive at the end of last year, the beginning of this year, of earnings for the S&P 500, which is a surprise to the upside. That's what we're seeing in the stock market. At the same time, you're also seeing stuff that's being stubbornly, persistently high, like real estate and rents, and that's another factor. And oh, by the way, you have geopolitical disruption and energy. We'll talk about that. That adds to fuel to the fire to the inflation conversation. But ultimately, inflation's embedded right now because we have too much stimulus still in the marketplace. It's the Inflation Reduction Act. A lot of that spending is being spent right now. So there's a lot of governmental spending out there. Plus, the consumer still has trillions of dollars in savings fueling this. And oh, by the way, the job market is still strong. So if a consumer has a job, they're going to continue to spend money. And that's all very positive for earnings and corporations. However, it's not what the Federal Reserve wants to see. Inflation is caused by too much money chasing too fewer goods. Milton Friedman, who is one of the best, if not the best, economist of all time, inflationary is monetary phenomenal. It's made by basically, or stopped by the central bank. And here's my favorite quote from him. If you put the federal government in charge of the Sahara Desert in 5 years, there'll be a shortage of sand, which is true. So inflation and restrictive monetary policy in the Fed's last mile and the ECB. Why I brought up the ECB is because Christine Lagarde, who is basically their Federal Reserve Chairman of the ECB, has talked about she's going to be data dependent. There could be another rate cut or their first movement on rate cuts could happen as early this summer, but it's wait and see. They're seeing growth in their economy. They're seeing a turnaround in their economy. That's turning up over there. Why that's important? Because they were the first to signal in September of last year that they were going to push pause on their monetary policy. We followed suit in ours in October, and markets took off since then. The Fed pivot, if you will. Now, but there's 6 reasons why we believe inflation is likely to be structural. 1, the nature of deglobalization or globalization, changing of globalization, right? Deglobalization. It's friendshoring or onshoring. We're seeing this, let's say if Iran, they're going to be pushed out with their energy. And now that's going to be causing more disruptive, more sort of onshoring and reshoring. Well, ultimately it becomes more expensive for everybody. And shorter supply chains, industrial policy is going to add to inflation. US housing is another reason there's a shortage. And there's a major affordability issue, both not only with the interest rate, but also with the pricing. So it's keeping inflation embedded in our system. Labor shortage, the jolt market. So there is reported that 9 million job openings, and that needs to be what the Federal Reserve is looking at. Full employment and price stability are their two mandates. And they're looking at how they could disrupt sort of that job market, opening up, sort of closing some of the openings and hopefully closing that gap, maintaining a healthy economy. That's kind of what the tightrope that they're working on. Number four, the few signs of fiscal discipline. The federal government just continuing to spend money. We're going to see more aid for Israel, more aid for Ukraine, sort of more budget issues for the United States. So that's kind of a mess into its own. And 60% of the federal budget is now indexed to inflation, which means when treasuries re-up, which we're seeing a lot of, they're higher. And that could be another issue longer term for the government. Those are all inflationary pressures. And basically environmental policies over energy. This is rising, a lot of EVs are going that direction. A lot of money has been spent that direction. There's sort of a pullback right now in the marketplace on the EVs, and fossil fuel prices are now on the rise. And this is Professor Jeremy Siegel. I had the privilege of having Professor Jeremy Siegel as my professor when I was at Wharton Business School. And he has been very famous talking about, historically, evidence has shown that inflation rarely spikes just once. In fact, 87% of the time, inflation comes in multiple waves. So let's just look at this. Shifting to inflation, the personal consumption expenditures, the Feder's preferred inflation measure. Here's the good news. The good news is that the Fed is looking for this to come down, which it is, in this direction. The challenge is moving forward is it could plateau, right? The rate of change is changing, and it might not come down as fast as the Fed needs it to come down. And so that's where we all need to pay close attention. Again, both the ECB as well as the Federal Reserve here. Another indicator of the CPI, Consumer Price Index, was hotter than expected last Wednesday. Basically, and that's what jolted the stock and bond market. And the number one question for advisors should be, is there going to be a broader pullback in the market as a result? Ultimately, markets seem to be taking this in stride. I'm going to skip this. This is a lot of jargon, but this is really what it's going to go into. Price changes of the CPI. And I show this every time, either with me in front of sort of a one-on-one or on these webinar updates. And this is the CPI, consumer goods, services, and wages by way of the government, okay, since 2000. And this shows all these different lines are the different indices of the inflation rate or the growth rate. And what I love about this is what's in the composition that the government uses for when they say the CPI is either growing or shrinking, right? And a lot of this is goods oriented, but majority of the CPI wage inflation is service oriented. Service post-COVID makes sense, right? Hey, listen, out of COVID, everyone wants to go on basically trips, planes, trains, automobiles. We're seeing that in the healthy print of earnings from the travel sector. And that still is flowing through. Even in restaurants and their higher costs, they're also higher labor costs, especially in California, just raised minimum wage to $20. So a lot of these companies are just holding up shop and saying, we can't take it anymore. And so, but what this is showing is hospital services and tuition. So what I always say to clients, hey, listen, what do you spend money on? What do I spend money on? Well, I have got 2 kids in college and 2 kids in high school. So we spend a lot of money on college tuition, right? And the double-digit rate of inflation is for the college tuition, as well as medical services. Those are the highest 2 right here. So the blue and the yellow. Medical services all the way down here, and everything else down to the bottom. This is again a wage, this is inflation indicator by the Federal Reserve, and it's showing TVs and toys and computer software. That's deflationary. Well, no doubt, I'm not going and buying a TV every day, Mr. and Mrs. Government Analyst who puts this together, but I am paying college tuition, and that is going up by double digits. So what you and I need to do is hedge our bets by putting our investments in companies that grow ahead of inflation, because we need our purchasing power, i.e. the CPI, what you and I spend money on, to grow, because that's a double-digit rate. Forget the 3% or the 2.5% that the government thinks you and I are spending our life in. In California, it's at least 10% growth every single year of what we spend money on. This is what Professor Jeremy Siegel is talking about. And this is our friends at Strategis who showed this. just so well. And all of these different reports going back to 1910, these are the wages, or excuse me, the waves of inflation coming through multiple years. One of the charts is, or excuse me, one of the lines is showing 1910, the other one's 1939, 1972, 2019. 2019 is the blue one here. So the blue one's right here. This is where we are. And the other ones are what we're talking about. And they're very similar trajectories, right? The first wave of all the three previous sort of inflation waves, or even back from the 70s, this is the 70s, which is the red one. Okay, it goes to a point where there's declining, this first drawdown of inflation. The concern right now is this right here, and this is for everybody, the Federal Reserve and everybody. The direction of this, does this, historically speaking, follow what happened in the 70s, what happened in the 1939, and what happened in 1910? We don't know. This is the biggest concern to the market. This is the biggest concern to the economy. This is the biggest concern to the Federal Reserve, because if this actually takes place, okay, the Federal Reserve will have to raise interest rates to restrict this, as they did in the 70s. So this is the biggest concern right now, is pay attention to the CPI, pay attention to core, pay attention to the PPI, all of these data points what the Federal Reserve is paying attention to. So we are too. And this indicates and directs when, if at all, the Federal Reserve will lower rates. We believe, and what I said, higher for longer, they'll have to keep interest rates higher to keep this down. If they keep high interest rates down or higher for longer, then this ensures that inflation ultimately is stamped out. That would be the way to go. But there are a lot of concerns moving forward. Again, this is a rebound in the interest rates. So the 10-year Treasury shows us one way or another that we could see interest rates above the 4.5, which we're seeing right now, but closer to 5. Job openings, ultimately what this is showing is this is the right here, this line right here are the JOLTS, the job openings. As I said, we were close to well over 9 million at one point in time, and it's coming down. And this gap right here from openings to job opportunities is, let me see if I have this. This is another way of saying it. So the unemployed, or the employed right now in the US economy is just over 160 million people. Job openings are 9 million, okay? So if you say, hey, listen, if we take 161 million plus 9 is 170 million, okay? Versus the labor supply. The labor supply only has available bodies to work and fill that 170 million. That's at 167 million, okay? There's a 3 million difference in demand of people that are needed to fill this gap right here. And that's exactly what we're seeing, the employment gap, that ultimately it's a labor demand versus labor supply. There's 3 million less in the supply than what's needed out there right now. And that's causing wage inflation, and that's causing the inflationary pressures. This is another way of looking at unemployment rate. Ultimately, we don't want the unemployment rate to get too out of hand, because historically speaking, when it constantly starts rising in a significant period where the economy has been hurt by restrictive policy, by a lot of change, recessionary, these gray bands are recession. And then in recession, every recession you're seeing, this employment really spikes up, unemployment rate really spikes up. So right now we're trending in the right direction, but the question is, can we slow it down to the point where it doesn't spike up and then we have a recession? All right, let's switch gears to a sector that we really like for a lot of strategic reasons and structural reasons. And it really comes down to what we're seeing right now in the SPR, and that stands for the U.S. Strategic Petroleum Reserve. We're at the lowest level since 1980. Our historical high was 726 million barrels that we've had in reserve. And that goes back to basically 2010, if you will. Now we're about 360 million barrels in our SPR right here. That's as low as we were in the 1980s, back in the early 80s. There's talk that we could also release, if energy prices start rising, the Biden administration might release more from the SPR and draw this down even more. regardless, structurally, this is going to have to be restored, whether it's this administration, a different administration. We're going to have more in the bank, if you will, not only for just common sense, but for a national security issue. So again, a lot of the investing that we do is common sense. A lot of investing you do, it's not political. It's just basically, hey, listen, this is where we are. The United States at some point in time is going to have to fill our gas tank back up. In doing so, that's going to cause it's a supply and demand issue. Energy prices are going to go up. Also, in 2023, we're expected to see record demand, which we've seen, and the trajectory of demand of oil. This is an estimate on this orange little dot plot line, is that it's projected to go back online, as you're seeing with the historical average that we've seen over time, right? Going back to 1993, it's basically our production as well as our demand is in line. So in addition to, we have to basically fill our tank back up in the United States, plus demand is going back to more pre-COVID numbers. Oil demand is expected to recover, and we're seeing that. That just means more to the system. Let's go to the election. I know a lot of people are always asking us about, Rob, let's get us some good election information. I think it's kind of always fun to do that. So our friends at Strategis, Dan Clifton and a few others are #1 in their sort of year over year. It's an independent firm that does nothing but research. And one of the divisions is their policy update and ultimately what's happening in Washington. And I just got this fresh from them yesterday for this. This is exclusive to us before they publish it, but it's also about, they produced 2 different baskets of stocks or an index that they put together that really help them gauge at any moment in time, and this is most recent, what basket is performing well, which means a basket of sectors. What sector is performing well? Meaning, as we get closer towards the election, does that give us any indication of who actually, because that basket is performing better, that index is performing better, who's actually in the lead versus the polls? So this is sort of where people are putting their money and what stocks are doing better, what sectors are doing better. And so they've basically put together a Trump portfolio and a Biden portfolio. And so the Trump portfolio is red and the Biden portfolio, the Trump portfolio here relative to Biden is blue. And then the predicting it, Republicans' odds of winning is ultimately what this is. We also have a Biden portfolio one too. But what this is actually showing us is the Trump relative to Biden is turned up a little bit, but the odds of a Republican president are going down. That's kind of interesting right now. So even though Trump's outperforming Biden, the predicting of a Republican president based upon now what's in the Trump basket. You know, you've got companies that are energy heavy, you got defense sectors, financials, you have healthcare a little bit, as well as, let's see, merger and acquisition and telecom regulation. But on Biden, there's technology is in favor, electric vehicle credits, renewable energy credits. Healthcare is a big one, more than Trump, if you will. And then a no border adjustment tax, there's companies that are ultimately in there, affordable housing, a few others. So there's kind of fun to see sort of, we've got the list of both if you're interested. We're happy to share that with you. But let's go to the next page. Here's what Strategis had said. They basically said it's not the third party ticket, let's say with Kennedy, that's going to potentially determine. It could be Warren Buffett in the 2024 election. Now, Rob, what is that? Well, Omaha in Nebraska, the second congressional district, is ultimately a huge battleground state that is going to be highly contested. Because remember, Nebraska, it doesn't have to vote the whole state. They can sort of take their electoral votes and cast them as they so choose. And so this is showing Nebraska's second congressional district, going back historically speaking, presidential voting. And yes, we've got Bush and Dole and Bush Senior, Bush Junior, and then Obama, Romney. So it flips flops. It went for Obama, it went for Biden. Well, I guess one of the questions here is went for Romney, even though Obama had a second term. So it's totally a crapshoot. What I will tell you is the amount of spending that's been projected to happen here in this district between August and election day is 3 times what it was. So it was 700,000. Now it's going to be 2.3 million in just that district based upon what the Democrats are planning on spending But here's also what's interesting. We have not released a new third party in focus. Today is attached. Let's see here. But with Democrats leaving RFK and coming to Biden, which is helping boost Biden in the polls in recent, Biden also benefits from no labels deciding to launch their ticket. So there's another one that was looking to do it, but they decided not to. You may find the second attached report interesting. We released it last month, and now we can view it in a bigger, there's the biggest risk to neither Trump nor Biden winning the requisite 270 electoral votes. Is not a third party, but it's Nebraska's second congressional district. If Biden wins all of, here's the key point. If Biden wins all of the blue wall states, Michigan, Wisconsin, and Pennsylvania, and Trump wins the Sun Belt states and flips Nebraska's second congressional district, that would lead to a statistical tie in the Electoral College of 269 and 269 scenario. Such, the newly elected House would be forced to decide the president election for the first time since following the election of 1824. It can't get stranger than life, right? That's crazy. So what are the three key metrics that determine if Biden's momentum is real? Number one, the approval rating. And that's why you'll see on a headline all day long, everyone's paying attention to the approval rating. Ultimately, the approval ratings really make certain that if he's got to get this back up, this has to go back up to closer to 50%. Historically speaking, a president approval rating is a rough proxy for the percentage of vote they receive in re-election. Biden's is too low to win today. If Biden is successful in turning the race into a choice, we should see an approval rating improve higher. So right now he's at 40.8. That's why they talk about that on TV. So number one, the approval rating has to improve for Biden's momentum to be real. Number two, the economy. This is a misery index. So it's inflation plus the unemployment rate. If you add those two together, historically speaking, that needs to be around 7.3%. Right now, that's working for him. It's about 7.05% on a 3-month average. So this needs to stay. So inflation needs to come down. Unemployment needs to stay down so this doesn't spike above that 7.3. So the economy, historically, the misery index, unemployment, is down year over year if the incumbent wins. The misery index will need to stay below the 7.35 in October for Biden. This gives him some wiggle room, but the biggest threat to Biden's reelection is a resurgence of inflation in 2024. That's where inflation's coming back in. That's where the Federal Reserve's coming back in. They have to keep it higher for longer because if they don't stay restrictive, inflation creeps back in. The Federal Reserve is non-political, and they say they have to be apolitical. But historically speaking, we've always seen a rate cut right before the election. Not always, but on majority. That hasn't been political. In fact, Nixon was very, very clear to his Federal Reserve chairman and said, okay, I gave you what you wanted. Now you have to give me a rate cut. That was on record. Nixon should have never said that, and that's not even proper to say. But again, history is history. And so you see that. So they always say, we're not going to be political. Federal Reserve chairman says, I'm not going to be political. Pay attention to inflation, because inflation stays where it is or gets hotter. No rate cuts. No rate cuts means the economy could be more restrictive, less growth. Less growth means it's not going to be what Biden needs moving forward. So this is becoming interesting. Now, and number three is the swing states. Ultimately, sorry, California, we don't matter. But here are the states that matter. The blue represents right now the polling and showing that Trump is leading in polling in all of these states, from Michigan, Georgia, North Carolina, Arizona, Pennsylvania, Wisconsin, and Nevada. But Biden, let's see here. So Trump is beating Biden in all 7 swing states. Biden has made progress in each state since the general election started last month. Biden is now within the margin of error within the blue wall states, Michigan, Wisconsin, Pennsylvania, and closing the gap in the other southern suburban states. So we'll see how that plays out. Now, we always have clients every single time there's an election, every single time. Rob, I don't like Trump. I don't like Obama. I don't like Biden. I don't like Bush. Get me out. Just get me out. They're going to crash the economy. It's going to be end of the world. I don't like that person. That's not somebody I would vote for. I don't trust. I want to move. Whatever it is, we hear it every single time, and it doesn't change. It just changes and gets a little bit higher in terms of a pitch as we get closer to November. And ultimately, I like to say perspective is important. This is showing the S&P 500 performance going back to 1949. The black line is the line you want to pay attention to. It's what we keep focused on. This is if you stay fully invested. Doesn't matter who's in the White House, red or blue. Our clients like green. They're paying us for green. So if we could keep you invested and looking forward in long-term perspective, this is where you are, well over $3 million. Now, if you say, I'm only going to go when my guy's in and it's Republican and red, well, that's a terrible decision because you basically may not even have 250,000, okay, over that period of time. Or even blue. My guy's, or gal is blue. Well, that's wonderful. You'll do a little bit better than Republicans if you stick to that team and that theory. But ultimately, guys, it's the economy because of earnings. So let's keep an eye on that. Presidential election years moving forward since 1928. The S&P, how it's performed historically based upon that president and over their period of time. So Biden, right now, we're looking at S&P average rate of return of 18.4% under Biden since elected. That's damn good. Historically speaking, really good. Okay, obviously we had a COVID rebound. Trump was at 12%, Obama 16 for the second term, down 37 for the first term because of the great financial crisis. Bush, anyway, this goes all the way down, and it just shows there's only 1, 2, 3, 4, 5. Ultimately, what this says is, historically speaking, there's only a few periods of time where we're seeing, all election years, well over 11.5% is the average here. And again, if you want to really be specific, some do better than others, but it ultimately comes down to the economy. Here's a little bit on real estate and why real estate slowed a little bit. It's because if you're a real estate investor, the cap rate versus the 10-year treasury, and the cap rate basically is your yield, your cash flow on the property, and the 10-year treasury yield is now higher than the cap rate or the percentage of an investor can get from buying a house or renting it out. Ultimately, treasury yield, just think of it like your mortgage rate. You lock in a low mortgage, you're getting, let's say, rent up here, which is your cap rate, and then this is the spread that you're making on a monthly or annual basis. Now, this is a push, right? What you're gonna get money on the bank for and what you could actually get in terms of rent, you're not gonna make any money. So investors have sort of said, hey, wait a minute, let's take to the sidelines. And the first-time home buyers are waiting for markets to come down, but this is very important. Federal Reserve knew this. That's why we want to slow the economy a little bit down, especially real estate. But if this dips at all again, because interest rates come down, the 10-year treasury comes down, this comes down, that spread in cap rate, again, that delta of what you can basically borrow money for and then lend it out for, get income in, that's going to then create a delta again, a spread, and therefore real estate will be more attractive again. So we got to watch that. And also there's 7 or 6 trillion right now in money markets. That just means that there's healthy economy, healthy consumer right now. And this just shows that it takes a long time to get this last mile down for the inflation. Here's a concern: less energy, rent, and primary residence. Okay, right now, historically speaking, this is what the Fed's worried about is the average change annualized on a 3-month, 6-month, or year-over-year, strong acceleration in super core inflation. And now over 8% really accelerating. This is important. We'll take a picture of this and keep following that, and that's what the Fed's looking at. Probability of recession, that's falling because earnings have come in. Let's go to earnings. The S&P 500 in the first quarter is double-digit earnings, as well as double-digit, 10% in terms of a great quarter. The first time since 2012 that the S&P generated consecutive quarters of double-digit performance. Ultimately, strong earnings were a result of that, reporting 7.5% year-over-year earnings growth. Keep in mind, folks, no one expected earnings growth, so it was supposed to be flat. Okay, 2023 we're supposed to get a recession. What would happen? No recession, earnings growth, economy did well, and the consumer hung in there, and earnings hung in there as a result. That's why we saw markets up 20% last year and now 10%. So we've seen quite a stretch, okay? Crude oil and copper and everything else, all the commodities, again, alternatives need to be in the portfolio. Those are inflation hedges. We're seeing them move as we're seeing. Earnings outlook. Now, here's where we want to take a look. The S&P 500 is the green index. Okay, so right here is the S&P 500 by way of where we are, over 5,000 right now. Okay, we're hovering. We were here. We pulled back a little bit. The S&P index earnings per share forecast for the next 12 months is what the earnings will be in blue. So what the S&P 500, all the companies, you take their earnings, you add them together, you're hovering, anywhere about $250, okay, is what we're estimating right now. What this means is the index, right, the current price of the S&P 500 is way ahead of the earnings expectations. One of two things: we got the second quarter earnings. Does earnings tick up and close this gap, or does the S&P 500 index come down? Now, the index has already come down in anticipation of earnings not being able to sort of close that gap for the second quarter. And there's opportunity for the S&P to come down even further. That's not uncommon, right? Another 5% pullback here in the S&P as a result of earnings season, where this gap closes more of a healthier sort of parity movement. But there is information technology year over year, 17% in earnings growth. So people are like, oh, why is large cap tech still taking off? Why is Magnificent Seven still, every day it's going up for the most part? They're taking a breather year to date because the earnings are there, right? Earnings don't lie in terms of the direction of where the potentially, where the cash flow and the health of that company. Communication services, healthcare, those are all great. Where we like is energy, right? Earnings growth is expected to be negative. If it comes in positive, well, then we're going to have nice upside surprises. Again, I gave you the energy case, supply and demand basics, and geopolitical issues. But more importantly, energy and materials are those that were out of favor last year that are actually leading the charge year to date in terms of performance. Energy is up 12%, and information technology or technology is up 4% year to date. The key factors to watch in the earnings season: the re-acceleration in earnings of what we just discussed, coming off of anemic growth in 2023, just under 1%. Okay, so we consider, hey, can we still see earnings growth moving forward? That's what we're going to be listening to and watching for. AI, corporate adoption. This is sector agnostic. It started off in the technology sector, but it needs to be widespread to stay competitive moving forward. Every company needs to adopt AI, and you're seeing AI basically make every company more efficient, faster, and stronger. If you haven't tried AI, you should try it because it's absolutely amazing, especially in the few first innings that we're seeing. Corporate America adoption, we're going to see more and more of this. Those efficiencies are going to drive productivity, top line and both bottom line growth, and that's where earnings growth may be able to come see more of. And then margin expansion, in order for the market to rally to continue and broadening out from the growth in these sectors, needs to continue, like energy, financials, and materials, as we talked about. Another reason why we're seeing health in the economy, or excuse me, health in corporate America, is don't look farther than just the dividend conversation, right? Corporate America is strong with cash, and they could also do cash buybacks. So when the markets pull back, okay, and if the markets pull back, corporations are going to go back and buy their own company stock back. Okay, they're going to reinvest in themselves, take out less shares, make it more profitability, their earnings per share more profitable moving forward. That's a playbook they've been doing for years, and they have the cash to do it. So I wouldn't get too spooked out when markets pull back, because companies are going to go and buy their own stock back. And oh, by the way, they also have cash flow. So look at JP Morgan, Chubb, insurance companies are raising prices. So these are all dividends that have been increased, and they're really accelerating their growth rate and their dividend rate. And this is just the first quarter this year of all these companies, Pepsi, Chevron, Cisco Systems, that are increasing their dividend by 7, 8, 9% moving forward. And you can't do that if a company doesn't sort of say, hey, listen, our dividend's intact, but we're also growing our dividend, if the earnings is not there. So you can't, again, fake that. Oh, this is a breaking news. Powell said likely taking longer than expected to achieve confidence to cut, right? Translation, higher for longer. So we've said this the last 6 months, and Federal Reserve Chairman Powell just confirmed it right now. So I think that's about it right now. That's all we have. That was my last slide, and we're coming up on the 50 after the hour mark. If you have any questions, we're happy to do some reviews, talk about positioning. Again, at Blanke Schein Wealth Management, we always take the long-term view. We have a diversified, customized, and balanced approach to your personal financial picture. We're happy to discuss any assets that are outside or even sort of real estate transactions. We're doing a lot of that financial modeling on the real estate side as well. And so an all gamut. If it's important to you, it's important to us. We appreciate your time today. Again, like and subscribe. Be sure to share this with friends and family that you believe might benefit from this. And thanks for watching today. We'll take care and we'll see you again next time.